Welcome to our second lecture in week 6 on Chapter 3, Working with Financial Statements. Now that we've had a chance to review the basics of these statements, we're going to understand how to use some of the data that are present on these statements. There's a couple of basic topics we're covering in this chapter. We're first going to look at cash flows and the financial statements. We're going to look at standardized financial statements. A brief overview of ratio analysis. We're going to briefly touch on the DuPont identity and then financial statement information. Our first topic is cash flows and financial statements, a closer look at cash flows. The most important aspect of cash flows is to understand their sources and uses. Where do they come from? Where do the various types of cash get used? How does cash originate, and where does it get applied in service of the organizational goals? Our sources are multiple. The cash inflow occurs when we sell something and we add it to the cash account. We can decrease in an asset account, such as an accounts receivable. We receive payment on an account. For example, when you pay your doctor's bill, the accounts receivable goes down, and it is a source of cash to the doctor. An increase in liability or an equity account, such as an accounts payable, we can experience cash from borrowing money. The uses of cash, again, are multiple. Basically, a cash outflow, though, occurs when we buy something. When we get an increase in an asset account, we buy an asset. Other current, we can use increase cash and leave it in a cash account or other current assets. We can also decrease liability, pay off a loan, or pay off say do a stock repurchase, something like this. So just know that there are multiple sources and multiple uses of cash. The statement of cash flows is a statement that summarizes the sources and uses of cash. And so this is very important for assessing the performance of an organization, because the changes are divided into three major categories. Operating activity, which includes net income and changes in most current accounts. Investment activity includes changes in fixed assets. And then financing activity includes changes in notes payable, long-term debt, and equity accounts, as well as dividends. And there are some examples of these three types of activities in your text. Just understand that there are different purposes for using cash. And so the changes in each one of these areas, the statement, indicates what management is up to on an almost a daily basis. We can take here this example, take a look at it and see. We start with 58 cash at the beginning of the year. We end up with quite a bit of cash more at the end of the year. And so what accounts for this increase of cash? Well, we had a huge net income, so we generated a lot of cash from operations, 1175. We had some investment activity, which was the sale of fixed assets. We had some net cash from investments. Maybe we had some bonds that paid us some interest. And then we paid off some notes payable, decreased in long-term debt. We had a decrease of the CS ratio minus the retained earnings, and then we paid some dividends out. So we ended up with net cash from financing, and we have a loss of 641. So we take a look at the gain from operations, the gain from investment activity, the loss from financing activities, and we see the cash at the end of the year is 696. So this looks like a pretty well-run company. We've got quite a bit of net income. We've reduced our current assets a little bit, but that's okay. We still look pretty liquid. We've got some money coming in from our investments, and we're reducing our debt. We're reducing long-term debt, as well as paying dividends. So this company is doing fairly well. Standardized financial statements help us get a better grasp on the financial statements in terms of how the elements are related to each other on an absolute basis. So standardized financial statements just make it easier to compare financial information, particularly as a company grows. They're useful for comparing companies of different sizes, particularly within the same industry. They offer a relative assessment among different firms, and then within the statement themselves, they give an absolute value because they show as a percentage of the overall overall total assets on balance sheets what exactly is going on within the company. Common size income statements compute all line items as a percent of sales. So we can see here that these values are percentages of both assets in terms of balance sheets and sales in terms of income statements. Ratio analysis is another way of looking at financial data. It's a way of analyzing the information to get meaningful insights into where the organization is. The goal is to take the numerous lines from both the income statement and balance sheet and to interpret this information in a meaningful way. And when we look at the income statement, balance sheet, statement of cash flows, simply too much information. It's just a jumble of numbers. It's really tough to make sense of this. And so ratio analysis offers us a way out. We just think of ratios as simply the construction of a numerator and a denominator, using data from a balance sheet and or an income statement. That's all it is. It's just very simple. So it gives us a comparative assessment of two different numbers. And the numbers that are selected are based on different performance aspects of the organization. Ratios allow for better comparison through time or between companies. And as we look at each ratio, just ask yourself, well, what is the ratio trying to measure? And why is that information important? How can that be used in making decisions? One of the things that you'll find is that when you recommend projects, the financial analysts in a company may take a look at the effect on ratios, especially for publicly held corporations, because they are used by external analysts to determine the value and market share of a stock price. And so your impact of your project recommendations can be assessed using the ratio. There are a couple of different categories of financial ratios. The first is short-term solvency or liquidity ratios. These are important because they represent not only short-term operational efficiency, but the tendency towards bankruptcy. The second are the long-term solvency or financial leverage ratios. And these, again, indicate solvency and are more indicative of a bankrupt position for the organization. Asset management or turnover ratios tell how effectively the managers are using their assets. Are they very productive? These are productivity-based ratios. Profitability ratios are efficiency ratios. Has the organization been efficient in its operations, or are the costs exceeding revenues? And finally, the market value ratios. How is the organization perceived in the external world? Is it perceived better than it perceives itself based on its book value? Finally, the important part of this chapter is to understand how to use financial statement information. Why should we evaluate financial statements? Well, there's multiple external uses. Creditors look at the financial statements to assess the credit worthiness, and they can adjust the interest rates of loans based on the risk that they see an organization undertaking. Suppliers can look at the financial health of an organization and determine the terms of contracts, or if they're supplying long-term services, they can see or not what the terms would be in both money and time. Customers want to take a look at financial statements to see that the organization is performing well, and stockholders to see that their investment will be well protected. There's also multiple internal uses of financial statements. They can be used for performance evaluation and compensation and comparison between divisions or within an overall corporation. And it can be used for planning for the future. And this is one of the major uses of financial statements, in that we develop something called pro forma statements based on current year statements, and we project them out into the future, and we estimate future cash flows. Ratios really are useful when we use them in the process of benchmarking. And then we compare them to something. We can look at time trend analysis. We can see how the firm's performance is changing through time. We can use the data from comparative years' income statements and balance sheets of the same organization. This has also internal and external uses. The goal here is to understand the long-term performance of an organization in terms of the critical success factors that the organization has set for itself financially. So benchmarking is good because not only in time trend analysis are you comparing it to current, but you're looking at the past and seeing the trends. For peer group analysis, benchmarking is good because you can look at similar companies or within industries by SIC or NAICS codes, and these are simply indexes of types of industries within the world. So from an external viewpoint, we can see how well the organization is doing overall within its industry, and then from an internal, we can see how well is the organization doing over time. There are some problems, however, with ratio analysis. And so remember that there really is no single underlying unifying theory. So there's no way to know which ratios are the most relevant based on a particular organization's goals. Benchmarking is difficult, especially if you're a diversified corporation in 5 or 6 lines of business. And really, the accounting regulations are widely different throughout the world. So globalized companies and international comparisons are confusing at best and impossible usually, because there's just so many different ways that the accounting information, financial information is handled. Some industries have specialized ratios that have no comparisons to any other industry. There's also varying accounting procedures, first in, first out versus last in, first out for managing inventory, that kind of thing. There's different fiscal years, and so how are we comparing, especially when we do inter-industry comparisons? How are we looking at the same year? Are we looking at past years? Do half the firms' ratios reflect the current year and half reflect the past year? It's a very difficult situation. And what about extraordinary events? How do these ratios really don't capture whether or not extraordinary events have affected the financial status of an organization? There are also some ethics issues around financial analysis and the analysis of financial statements. Here's one: should financial analysts be held liable for their opinions regarding the financial health of firms? Kind of the management consultant dilemma, or the CPA dilemma, CFA dilemma. Even with a medical doctor, this is a liability issue. And how closely should ratings agencies work with the firms they're reviewing? For example, what level of independence is appropriate? And we saw this with the bond ratings recently, and some of the credit ratings of the United States, when Moody's and some of these other credit ratings agencies, it turns out, were doing consulting and getting paid by the very companies that were getting rated. So there's a conflict of interest there. So understand the terminology within the chapter. Sources and uses of funds, liquidity ratios, long-term solvency ratios, asset management ratios, turnover ratios, profitability ratios, and market value ratios, as well as what is the DuPont identity, how can it be used. So the most important topics of this chapter, well, the first is the statement of cash flows, what it is and how it documents the sources and uses of funds in an organization. The second is that ratio analysis. What is it? How does it work? Well, it dissects income statement and balance sheet information into understandable, discrete components in a ratio format. So it breaks down some of the basic statements into specific, meaningful indicators. The 5 categories of ratio analysis help to group ratios. Just make sure that you understand each category. And a DuPont identity organizes the ratios into a meaningful relationship based on a hierarchy. Finally, understand that trend analysis and industry ratios provide a benchmarking comparison, both on a longitudinal basis within an organization and between organizations and among industries when we start looking at an SIC or NAICS analysis. So that's it. If you have questions, please post them in the Q&A thread, and we'll see you in the class shell.